Hi folks, Eric from Hit Subscribe here, and I am doing yet another edition of the weekly Freelancer Q&A live stream / eventually YouTube video that I do each week. And apologies, I don't have my normal ring light thing in front of the camera, so I'm not sure if the lighting is the best, but it died and I don't have time to charge it. So that said, I think that the dark can flatter me at times, so I'm going to roll with it. Anyway, the question this week is, what are taxes like for freelancers compared to employees? Now, this one is great because I don't think it actually requires a whole lot of context to understand. So this is somebody who is a US-based employee that's curious what taxes are like if you're a freelancer and how they're different. So that is what I'm going to walk through today. Now, I used to do this in the early days of the videos because this would come up a lot, but I haven't done it in a while. It is disclaimer time. So first of all, I am not, thankfully, an accountant. That is not what I do for a living. None of what I say here should be construed as official accounting advice, nor should it be construed as official tax advice or legal advice or anything else. Just, this is all for novelty, recreational purposes. In all seriousness, the way I like to frame this is anything that you might construe as advice is really more, this is my experience. This is what I would do if I were starting a business or going freelance. So take it as it is. I am an experienced business owner. I have started a number of different LLCs, and I definitely have tax experience, but I'm not a professional giving advice for pay in these fields. So that's caveat number one. Number two is a little bit easier to wrap your head around, which is this is all US based in nature. Like the person asking the question and I are both US citizens. I don't know how much this particular video will translate internationally, so it may well be that this is one worth skipping if you're based in Europe or Africa or something like that. I don't know. I mean, I'm not encouraging you to drop off and kill the channel's metrics or anything, but I think this one more than others is probably somewhat US specific. So with all of that out of the way, let's just roll up our sleeves and dive into taxes here, which is, how I like to spend my evenings. So if you are an employee in the US, a W-2 is the name of the form that the IRS will send to employees. Colloquially, this is called W-2 or salary employment. If you are an employee, the way that income taxes work for you vis-a-vis your employer is that you fill out a form that is called a W-4 when you go to work for them. And this form has to do with what's known as withholding from the IRS. So you go in and you fill out some information, probably, I forget, it's been a while since I filled one out, but are you married? How many deductions do you claim? How many dependents do you have, etc. And what this form is designed to do is it is designed to help your employer understand how much tax to withhold from your paycheck. So anybody who is US based, if you're salaried, you're used to getting a paycheck, and they tell you at the top, here's the amount you earned, and then they're yeah, but here's what you're actually going to get, and it's a much smaller amount. So what actually happens is on your pay stubs, you will see how much tax is what's called withheld for the federal government, for the state government, assuming your state has income tax, and then for what are called FICA taxes, or FICA withholdings. So there is Social Security. What else is in there? Maybe unemployment. I can't remember for sure. But anyway, all of these roll up into taxes that are withheld for a few different purposes from your paycheck. You would also see withholdings for things like health insurance, 401k if you're contributing, etc. So a lot of things are pulled out of your paycheck before you ever see it. I won't get too deep into the reasoning behind that, especially since some of that would be speculation. But the idea is your employer issues you a paycheck, but before you ever see it, your employer hangs on to some of that money and does stuff with it. And some of that stuff is related to paying taxes. So that all happens to you without you really having to do anything. So let's just, for the sake of easy math, say your paycheck is $5,000 per month and that your withholding is $1,500. So you actually get $3,500. You get a paycheck that says, here's your $5,000, but all these things have been withheld. Here's what's going to hit your bank account direct deposit, $3,500. That's the world you're used to. So what's going on there? I'll get into this a little bit first so that we can dive into some aspects of freelancer taxes that can be a little bit complicated. But what's actually going on is your employer takes money out of your paycheck and they hold it in, I'll call it a form of trust, if you will, through your payroll provider. They take that money from your paycheck, and your employer, instead of giving it to you, actually sends it off to the federal government. So every time you get a check, right about that same time, your employer is sending money to the federal government, to the state government, probably the Department of Labor, depending on certain things in your state. And they're doing this on your behalf. So if you are employed and getting, let's say, 24 paychecks a year, 26 paychecks a year, on a pretty regular basis, your employer is giving the federal and state governments money that has to do with your employment. And this is going to be significant later. So your employer is paying what is known as payroll taxes on quite a regular basis to the federal and state institutions. They get a nice stream of money constantly. Remember this, I'm going to talk about it here in a second. But that's the kind of workflow. So you get this pay stub and it says, here's what you earned, here's what we're giving you. And then while that's going on, your employer is sending money to the feds and to the state. That's generally called withholding, to recap. So you quit your job and you go off on your own, and you no longer have any of that happening. So as a freelancer, the first thing you'll notice that's different is you send an invoice for the $5,000 worth of services that you did for Acme Inc. Acme Inc. just cuts you a check for $5,000. Now, the first thing here to bear in mind is this is not a bank error in your favor, and that is not all of your money. The federal and state governments, in their appropriate capacities, are going to come a calling for that sooner or later. They will consider it money that you owe them. They just don't know about it quite yet, but they will be there for it, believe me. So understand this, first of all, that you as a freelancer compared to an employee, you assume an entire world of responsibility for taxes that you're not used to. It becomes incumbent upon you to go to the government and say, hey, I got some money and I owe you some of it. You have to figure out when to do that, how much to do, and the rules and regulations and procedures for paying the IRS and paying your state government, sending things to the Department of Labor, and so on and so forth. Now, I am going to give advice here on the assumption that anyone who's wondering about this is probably going to form an LLC and have a relatively simple tax situation that is known as a pass-through entity as far as the government is concerned. What that means is that you are basically just filing articles of incorporation with the state. And, well, I don't know if you can hear that. There's a lot of action going on. Acoustics in this house are interesting. Maybe I'll try to edit that out. Maybe I won't. I don't know, but things are getting wild. Anyway, you owe all this responsibility. You have to keep track of all these things and where to send all of this money. So I was saying that on your own, you are responsible for withholding, or excuse me, sorry, I was saying that you are a LLC filing through a pass-through entity, which just means that you assume kind of all taxable responsibility for yourself as a business entity. There is no corporate return that you're going to file for your business. Rather, you're just paying personal taxes, even though you have a business. So if you go out and you form, Beta LLC as your business, Beta LLC doesn't file a tax return. It exists as a legal entity so that you don't get sued. But as far as the IRS is concerned, you're just an individual taxpayer. All of the tax stuff for Beta LLC just passes through to you as an individual. That is almost certainly what you are a freelancer is going to do for taxes. Now, let's get into self-employment tax because that's fun. It's the first gotcha that's going to really gobsmack you as a freelancer if you're not prepared for it. When you are an employee, there is this concept of payroll taxes. So what I mentioned is FICA before, Social Security, federal unemployment, maybe? I can't remember what they all are. But the idea here is this. When you pay taxes, you pay the federal tax that you owe, income tax. You also pay the state income tax that you owe. But you and your employer actually split the bill on these FICA taxes. And I think those total up to 13% of your pay overall. What happens is your employer pays 6.5% and you pay 6.5%. So you see that withholding on your tax. But what you don't see is the amount of money their employer is also writing a check for. So they are paying taxes to employ you. When you go off on your own, the IRS looks at you and says, oh, hey, you are both the employer and the employee, so I want both of my cuts. This 6.5% tax hike that you will face as a freelancer, self-employed, is often going to catch new freelancers off guard, and it is a bummer. You just have to eat this unless you get into a more exotic tax situation, like in filing as an S corp, which I would do if you're running payrolls. But anyway, that's a topic for another day. At first, you just take this on the chin. You need to charge in such a way that you're baking that into your cost assumption. So you are now assuming the employer's responsibility, and that's not zero. In fact, that is 6.5% at the federal level. So you will get a 6.5% tax hike just because you're self-employed. And that isn't the end of the fun surprises, by the way. When you are paying taxes for yourself, you get a grace period of a year, but after a year, the IRS is definitely going to want you to file what is known as quarterly taxes. So the first year you go off on your own, maybe you don't know this, you're just collecting $5,000 a pop from your various clients, you're putting it in the bank, and hopefully you are setting aside some to pay the IRS. The first year you do that, come tax return time, you might find that you owe the IRS $25,000. If you've set aside money as it comes in, which I'll get to in a moment, that won't really get you off guard. But if you find that you're writing the IRS a massive check at the end of the year, and remember I said to put a pin later in how frequently your employer sends checks to the IRS will say, hey, you owed us a lot of money, and you know who gets to earn interest on your money? It's me, not you. So you need to pay me more often. I don't want that money sitting in your bank account earning interest. I want it sitting in our bank account earning interest. So the IRS will come to you and say you need to file quarterly estimated tax payments or we will fine you next year. And they will. So you actually have to pay the IRS and your state tax state tax institution in most cases. You have to pay them taxes 4 times per year. Also, here's a fun thing. The IRS's quarters, when they say they're quarterly taxes, they're not your quarters. So the first quarter is an actual quarter. The second quarter is just May and June. So quarter 2 is 2 months. The third quarter is July, August, and September. And then, wait, no, that's not right. Sorry. May, June. I'm getting this confused. But anyway, they're not quarters. They go 3 months, 2 months, 3 months, 4 months are the IRS quarters. That's definitely going to mess you up the first year. You're going to file your quarterly taxes a month late because you're, like me, going to make the ludicrous assumption that when they say quarters, they mean quarters. So no, you have to file those in early April, then again in June, then again in September, and then again in January before you file your actual return. I know all of this probably sounds complicated as I'm running through it. I'll kind of run through a summary at the end to decomplicate it a little, but I'm just trying to be thorough. So to recap here, you have to assume responsibility for your own taxes because nobody's sending them in on your behalf, and you have to disburse them to the government 4 times a year in addition to doing your income tax return. You don't just get to send them all in at the end. Now, let me talk about for a moment how I would approach tax strategy as a freelancer. It's not overly complicated. You could go figure out on the IRS website and using your state government's website, like what your exact tax burden is for a given amount of income. The federal government and some state governments, although I think most have flat taxes, but the federal government has tax brackets, meaning you pay a certain rate on the first 20%, well, it's probably 0 on the first 20% of your income. But after that, 20K a year to 50K a year, you pay 15%. Then 50K to 100K a year, it goes up to, I don't know, 22% or something. That's what they mean by brackets. Depending on your income, you hit categories where they start adding on marginal increased tax. That just further complicates things, but you could theoretically figure out, hey, I am married, filing jointly. I have so far this year earned $132,000. This is not my actual personal situation, but if it's you, so far this year I've earned $132,000. You could figure out exactly what you would owe the federal government on that, less withholdings and stuff. But you can take that information and think through what you're going to owe and make sure you have that set aside for the next time that you have to write a check. That said, I wouldn't do that. I would assume, unless you live in California or some like state, well, I assume they have a crazy high income tax. I don't know. But set aside maybe 30% of everything a client sends you. So if a client sends you that $5,000, 30% of that be 1,500. Just set aside 1,500 into. I would create personally, and I used to create an actual savings account. Client sends you $5,000, you deposit it in the bank. You just immediately move 1,500 into your tax savings account. If you do this every time you receive a check from a client, you set that aside. All you really need to do is empty out that savings account in proportion to, maybe it's 24% to the feds and 6% to the state in terms of estimated payments. So that 30%, you just empty out that account each time a quarterly payment is due. And just doing that will more or less get you right with the tax agency in question. So, you might wind up owing them a little money at the end of the year. You might wind up getting a little bit back. But if you just take that very simple rule of thumb and apply it, you'll probably be in the ballpark. Beyond that, I don't want to get too far down the rabbit hole of giving tax advice here. But that self-employment tax really does start to add up. And if you are earning maybe 150K a year in revenue plus, I would suggest that you start to think about incurring the complexity of filing as an S Corp, doing a corporate tax return each year, and paying yourself out of payroll. And the reason is that's probably around the revenue figure where that 6% or 6.5% incrementally, you're talking now maybe $10,000 in additional tax you'll be paying, where that $10,000 starts to be worth it to save, to incur the added expense of a corporate tax return for $1,000 and for running payrolls and the added complexity of paying Gusto $40 a month or whatever. So as your practice grows, if you're getting into the six figures, you might start to think about filing as an S Corp. That is a topic for a whole other day, but I wanted to plant that in your head just to say there is a world where you should start to think about that, and it would become worthwhile. So again, I want to summarize here and call it, but what is the difference between your taxes as an employee and your taxes as a freelancer? Number one, the whole idea of withholding, it won't apply to you. So your employer withholds, nobody will withhold with you as a freelancer. Number two, you're going to pay extra tax as a freelancer. Your employer was actually paying taxes for you before. Now you will pay those taxes. Number three, you are responsible for not only setting aside money to make sure that you can pay your tax bill to the various taxing entities, you have to do it more often than you're used to. So as a freelancer or a business owner, you're going to be worrying about taxes at least 4 times a year, if not more often, whereas an employee, you probably just, go to, what is it, H&R Block, and whatever, you get $1,000 back at the end of the year. Taxes will be more frequent and more complicated in your world than that. And finally, there are other tax structures that are more advantageous for you as a business owner, but I wouldn't consider them until your revenue gets into the 6 figures at a minimum, probably well into the 6 figures, and then those probably become a little bit more worthwhile. All that's out the window if you start hiring, regardless of your revenue. If you start having employees, I would go right to S Corp because you have to run payroll anyway. But absent employees, once you're into the 6 figures, you might want to start to nose around at the idea of filing as an S Corp. Until you're into the 6 figures, it's just more complexity than it's worth. I wouldn't bother. So hopefully all that makes sense and answers the question, and I will catch you all next time.